Hi, my name is David Hood. I'm Head of Central Investment Solutions at Brewin Dolphin, and today I wanted to talk about the benefits of segregated mandates in an MPS. So first of all, what is a segregated mandate? Well, a segregated mandate is where a chosen fund manager is selected to run assets within an account based on an investment management agreement that is agreed between the wealth manager and the fund house. Now, these segregated accounts can be aggregated up into a single fund, which is then referred to as a manager of managers. A manager of managers structure is different to a fund of fund structure. Within a fund of fund structure, as the name suggests, it's a number of funds within an outer fund. Whereas with a manager of managers structure, it's a number of segregated accounts within an outer fund. Now, whenever a fund is being run, it comes with costs in terms of fund admin and accounting, as well as regulatory costs. And with a fund of funds, therefore, you have two layers of costs. In a manager of managers setting, however, you only have one layer of costs, and that's one of the principal benefits of using segregated accounts in this way. The other benefit is slightly more subtle. With a fund of funds, if you want to make a change, you need to sell down a fund and then purchase a new one. And in that instance, the investor is incurring all the frictions of making that sale and repurchase, transaction costs, etc. In a manager of managers structure, a segregated account is being run by a particular fund manager. You can tell them that they are dismissed and appoint a new manager to run that account. And that new manager will time those sales and purchases more sensitively to the market conditions, and also they may not even need to turn over the entire portfolio when they make those changes. So on this slide you can see some examples of some segregated accounts within 4 fund structures. So to take an example of the UK equity fund in the top left, there is a core strategy run by JP Morgan, and then there's a value strategy run by RWC, which is complemented by a quality growth strategy run by Linsell Train. In terms of small cap exposure, there's Merian mid cap, which is paired with Teviot, smaller companies. So the mid cap gives you some growth exposure, and the Teviot gives you some value exposure in the smaller company space. So we can blend managers together to get a more rounded portfolio for investors. So the segregated mandate structure gives us a number of benefits to the client, from the regulator's point of view, and from the point of view of a wealth manager. So from the client's point of view, the structure of the investment management agreements means that we can negotiate bespoke costs that can be tiered, so as the funds scale, so costs come down for investors. We also have fewer platform transactions. When an MPS rebalances, more of those flows or transactions can take place within the funds rather than outside the portfolio and between funds. We have better options when it comes to manager changes. We can transition cash, we can transition assets, we can employ a transition manager where the situation is more complicated. We can manage fund closures. In a typical MPS, if a fund soft closes, then an MPS may be obliged to change its model to accommodate new investors in that MPS, whereas in this structure, the strategies can be capped and can be held on an ongoing basis. We can ring-fence liquidity in this kind of structure, so we can have a pool of assets that can act as almost semi-permanent capital within the fund structure, and so liquidity can be managed much more sensitively for those asset classes where it's appropriate, like smaller companies perhaps. And a manager of manager structure doesn't mean we have to forego transparency. We can still give a clear look through to investors so they understand what they're invested in. And all of this also helps from the regulator's point of view in terms of the asset market study that was done a few years ago. Regulators highlighted the fact that economies of scale weren't necessarily flowing back to investors, whereas in this structure they can and they do. And we are, of course, transparent with the charging in this type of structure too. Lastly, it's possible to access managers who aren't just standard retail managers. There are obviously some fantastic managers in the retail space, but there are also some great institutional managers out there. And this structure allows us to tap into managers perhaps who don't run a retail fund. And it also finally allows us an enhanced range of investment choice. There's the potential here to invest into ETCs, ETFs, or other structures such as investment trusts if appropriate. So to illustrate some of the potential cost savings, we have an MPS as it was prior to using a segregated mandate structure. So that's the first date there in January 2018. And then after a transition to the use of segregated mandates, you can see that in May 2018, you can see the costs comes down from over 60 basis points to somewhere between 50 and 55 basis points. And then finally roll forwards 3 years and you can see that the costs has come down to or below 50 basis points. So those economies of scale working in for the benefit of clients. And of course it's no good having low costs if the performance is underwhelming. So here we present the performance for some manager structures that are run at Brew & Dolphin, and we're delighted with the performance of those over the past 3 years since launch. You can see that the relative performance has been very strong, particularly in the North American fund. That was driven largely by the investment in Bailey Gifford American strategy, which had a particularly strong year over 2020. People be familiar with the incredible strength of some of the online platforms that were beneficiaries of the crisis last year. And so, really driving strong performance there. That's not to say we're complacent about the structure of these funds. We're always considering what blend of managers is the correct one to have in these funds and within MPS, within our MPS more broadly. And so that's obviously an ongoing discussion that we have within the firm.
David, why don't all wealth managers use segregated mandates?
Yes, it's a good question. I think there are a number of things that you need in place to be able to deliver them. One is scale. You need to be of a certain size to be able to negotiate the necessary investment management agreements. The other things are resource and expertise. So we need the fund research capability and depth and to really be able to assess managers and make the crucial decisions around blending and how managers should be selected within the funds and blended within the funds.
Is this just another way for wealth managers to charge clients?
It's a fair question, but with the MI Select Managers funds, there's no Brew & Dolphin charge on those funds. So clearly the charges are at the MPS level, and that's people are charged for the investment proposition, but there's no clipping the ticket twice. There's no charge on the MI Select Managers funds from Brew & Dolphin. Clearly there are fund costs to manage the funds and also to do the accounting and regulatory aspects of the funds, but Brew & Dolphin doesn't levy a charge.
Are segregated mandates restricted to use in just MPS solutions?
That's where we use them principally at Brew & Dolphin, but they're in no way constrained to just use in MPS. They're also used in our Voyager funds, which is a unitized version of MPS, and our investment managers at Brew & Dolphin have made some use of them as well.
Are you tied in to use the same managers for many years?
No, Bryn-Dolphin are not tied into using the managers for any extended length of time. We made a number of changes last year. We introduced TV at smaller companies. We transitioned to RWC, UK Equity Income, following the departure from 91 of the manager of UK Special Situations last year. We've also had instances where we've retained a manager where there's been a manager change in the past as well. So 91 UK Equity Income a few years ago, a new manager was brought in, and we were very comfortable to retain them. And so in that instance, we did retain the manager, but we're in no way compelled to do so.
Are there any differences between the segregated mandates and the actual retail funds?
Mostly we're modelling the investment management agreements on the fund objectives and guidelines for the retail funds, and so mostly we'd expect the mandates to run extremely closely to the funds, which they do, and we monitor any drift at all between the mandates and a fund. There are occasions where we think it's appropriate for fund managers to have a little bit more latitude, whether that's more concentration in a fund or a mandate, I'd highlight Baillie Gifford, where we've given them a bit more flexibility there. But by and large, yes, we want to know that managers are running to the strategies that they've been assessed on by our funds team, so they're running in the mandates in a way that we are comfortable with, and we know that they have a track record of performing with.
Why are the 4 select managers funds focused on the UK, the US and bonds?
So the UK equity funds, the North American fund and the bond fund, they cover something like 60% of the MPS assets, and so that was where we felt we could make the biggest impact on the overall cost in the short term. And they're also the areas where we felt we had a strong blend that we could deliver quickly and easily to clients. And so, that's where we were naturally drawn towards. But, that's always conversations around the desk about, what else can we do? How else can we improve the proposition over time?